All right, Eric Brown, sit down. Why is it always got to be Eric that we call out, right? Yeah, I know it. Hey, welcome everybody. It's a good crowd. You guys come on in. Nick, running late as usual. Hey, Nick. If you need to get a beer, feel free to go do that. We are going to get started here in just a sec. Trent is going live on the Spread the Positive Network. Are we live, Trent? Sounds like we're live. That sounds great. Okay. So for those of you that don't know me, my name is Jonathan Harmon. I'm with the J. Harmon Home Team here in Keller Williams and I've got two of my team members back there as well. There's Rabia Elisal, hey Rabia, and Brett Garner standing over there. You might not recognize Brett because he doesn't have a visor on his head. That is, yeah, there you go. That's much better, Brett. Thank you. And so this is our panel. I've been talking to Grant now for, I don't know, since like July, I think, and I keep pushing it off. But we'll start down on that end. This is Grant Hammond. He's with Metropolitan Brokers out of Nashville, and it's a small but mighty team that moves a whole lot of real estate in Davidson County. But the way I've gotten to know Grant is if you follow him on Facebook, he does a whole lot of analysis about what's going on in the market, why rates are doing what they're doing, a lot of predicting that tends to be fairly accurate, which is kind of crazy because I don't know how to do that. And he just does a great job of breaking it down into ways that normal people can understand. So this is Grant Hammond. We'll talk to him in a second. This is Brian Nail. Brian is with Primis Mortgage. Primis and Brian specifically is a guy that we refer a lot of business to with the J. Harmon Home Team for residential mortgages. Brian does a lot of studying as well to try to figure out why it's going to happen the way it is, and he does a really good job of telling people you should wait because this is going to happen. And that's been very important to me as we built this business. Is sometimes the best advice you can give is to do nothing at this point. And it's important that I have people in my team that say don't do anything right now. And then this guy right here, this is Ronnie Martin, this handsome devil right here. He thanks, buddy. Ronnie is with Pinnacle Financial Partners. I've gotten to know Ronnie in all kinds of different ways. So he was on city council for a little short period of time.
Four long years.
Yeah, God bless you. That's 4 more than I would ever care to do. But he also does some commercial lending and commercial banking, that kind of thing, and has helped me out with several different projects. So this is our group. We're going to let each of them kind of give you a little 1-minute elaboration on my introduction. So we'll start with Grant.
Not sure what else I can say. That's a great introduction. Appreciate that. 22 years in the residential business, mostly in Nashville, but Williamson, Davidson County areas typically. Have a couple of undergrad degrees. One of them happens to be in theoretical mathematics. And so that's where a lot of this predictive analysis comes from, especially when it comes to interest rates or what the economy is going to do. It's sort of an interesting hobby that has become a habit that I can't stop doing. And I think the value that I'd like to bring tonight is just to give you a sense of where we were, where we are, and where we're going in the real estate market, and to counteract a lot of the folks who say that we're about to crash or that this is going to get really bad because of what they felt during the Great Recession from 2007 to 2010. This is not that.
Excellent. All right, Brian.
So my name is Brian Nail, and I've been a lender in this community, or a banker, I should say, in this community since about 2005. And I'm an MTSU graduate. My wife and I are raising a family here in Murfreesboro. I love being part of this community. As an MTSU graduate, I serve on the board of directors for the Blue Raider Athletic Association with Jonathan and some other great folks. And just I feel like anytime that we can do anything to strengthen our community through our university or through various things like United Way that I'm also involved with, it's a great opportunity. And I think this is an opportunity too. Anything that we do through Spread the Positive that Trent Denson's involved in is a great opportunity for us to further improve our community. So I can't really say anything better than Grant did. What the objectives are for tonight is really just to kind of give some enlightenment about the market and where we think things are going. Some things we may end up at the same destination, but we get there in different ways. It'll be interesting to see how those things play out over the next 6 months to a year. And I think at the end of the day, we all kind of have the same mindset of where this market's going to go, both locally and nationally. And I look forward to sharing that information with all of you tonight.
All right, Ronnie.
Good evening. My name is Ronnie Martin, and thank you, Jonathan, for hosting the event. For you all that have been to Cedar Glades, this is a great place. Glad to have friends here, a lot of friends out in the audience, so thanks for taking the time to be here. I'm a local kid, grew up in Murfreesboro, also on city council, went to MTSU a couple times over, and
Like you just went on campus a couple of times, or?
yes,
Okay.
they still graduated. They wanted me
Right on.
off campus. But I am a commercial lender. I've done quite a few construction loans. There's probably not much in the realm of commercial finance I have not done, from apartments to single-family residential. So very happy to be here with this panel. I have a feeling we might disagree on some things, which I think would be great for the group, so that we can chop that up a little bit here. So that's always good to not have a singular opinion, but glad to be here with you and see all the smiling faces.
Awesome. So the objective from my perspective tonight is education, right? So you guys came because A, I invited a whole lot of you, but B, also you obviously have an interest in learning, what in the heck happened in 2022? What's going to happen in 2023? Are there opportunities? Did we miss some opportunities? And are there still some coming down the pike? And I think the answer to that is yes, you probably missed some opportunities, but there's also going to be a whole bunch of them that are coming as well. And so hopefully you'll learn a little bit. My goal is to have 45 minutes or so of Q&A, give or take. Just depends on what you guys can feed back. So we're going to go through a list of questions that they've had for a little while to chew on. And then, like I said, we'll wrap up with some Q&A. So keep some notes or whatever. And if you do have some questions, there will be ample time for that here in just a little bit. All right, we're going to dive right in, gentlemen. Okay, so the big story from 2022, of course, was interest rates, right? 2021, the housing market was bananas. People were buying stuff. I saw a meme one time where a buyer's agent, it illustrated this beautifully, so I'm just going to Reader's Digest it. But basically, the buyer's agent sent a blank contract to the listing agent and said, "Look, we just need the house. Write whatever you want on here." And that was 2021, right? 2022 started out that way, and then all of a sudden it wasn't. And a lot of the conversation that Grant and I have had has been that it is very singularly focused on interest rates and the effect that they've had on the market. So first question is, why did rates go up so drastically when they went up in such a short span of time? Why did that even happen?
Okay, I'll lead us off, and then I'll probably be the contrarian here, if you will. But so I think we'd start with a basic understanding of why interest rates, monetary policy, why the Fed does what they do. And so this is confusing. There's a lot of reasons they do it, but why did it happen as fast as it happened, and what was the objective? So you heard people talking about inflation numbers, right? So inflation is the average price cost of goods and services that you pay for. So it takes more money out of your pocket, whether it be gasoline, groceries, housing, wherever the case may be. The more expensive things are, you lose purchasing power as you do that. So how does the Fed combat that? One of the things they do is they can raise interest rates, right? So what does that do? How does that affect business? Depending upon the capital structure of your business, you either have debt or you have equity. People that are reliant upon debt to finance their business, it costs more to borrow money to produce goods and services, right? So the operating cycle of business gets more expensive because when you pay for debt to finance raw materials, services, other things, you have to charge more for your products, right? So that's inflation. As you charge more for your products, it costs more, which means people have less money because they have to pay more. So you want to combat that. What do? They raise interest rates to make it even more expensive, right? So what impact does that have on a small business? If you want to sell something, typically you have to lower your price because you get into a supply-demand situation where you're saying, how am I competitive in this higher interest rate environment? How do I sell something before my competitor does? How do I make sure that if it's really expensive to produce goods and services, how do I sell the current inventory I have? So an example of that would be if you went into some of the stores, especially retail, over the holidays, it was very noticeable. There was not as much merchandise in there, and the quality of merchandise was not as good as it might have been. And the reason is, if people are relying upon debt to buy raw materials to produce finished product, they don't want to borrow at 8% to do that, so you get less stuff, right? So they're trying to pull those numbers down, you have more sales. There's a lot of opinion and theory on how effective that works, but my answer to that question would be the Fed felt like that inflation was rampant and that it was eating up more of your dollars than were being passed on through employers, through wage increases, salary increases, and therefore you were limited in what you could buy and sell. How do we fix that? They jack those rates up to tell everybody else in the marketplace, this is not going to last. You're going to have to pull those prices down or you're not going to sell anything. And so that's what you're seeing. It's just moving really slow. I think the reason that it happened as quickly as it happened is because it is worse than what some people think it is. And so I don't necessarily have the same rosy opinion that it's going to be great in 2023. I think it's going to be painful for us. And it'll probably be painful in 2024. How painful, I don't know.
I would just add that the reason that it was worse than they may have thought it was, I don't know that that's the way I would say it. I think they knew it was bad. I think they wanted to raise
And
rates.
the it here is inflation.
Yeah,
Okay.
it's inflation. Thanks for the clarification. The Fed knew that inflation was getting away from them, and they wanted to raise the interest rates in 2021, and they started to. Coming into 21 out of 20, we thought the refi boom maybe had a couple of months left in it, and then it extended, and a lot of people who weren't able to get refinanced in 2020 for various reasons kind of got a second crack at the bat. And and that happened because Delta and Omicron variants of COVID came out. You know, the reason rates fell as low as they did by the Fed was to keep the economy going during COVID. They wanted to raise rates, and they thought that they kind of had things under control as we rounded out of 2020. And then this new variant came out, and all of a sudden now, I think it was Omicron first, maybe it was Delta first, I can't remember the word, but all of a sudden now, kids are getting sick. And oh my gosh, if COVID's now affecting younger people, it may get really bad out there. So to keep the economy going, keep activity moving, they did not raise rates. As soon as they started to, they flinched. And the soft landing they wanted to orchestrate didn't happen.
And that was December or so of 2021, right? Yeah.
Yeah.
I remember that.
And so that led to rapid rise. And so when they finally came out and said, hey, we're going to have to raise rates, it wasn't a slow walk up. It was a quick move.
Got it.
So another piece of why they rose so rapidly was the money supply was expanded greatly through a couple of distributions in 2020 and 2021. And in order to shrink that money supply, the Fed has stopped purchasing mortgage-backed securities. And that led directly to a little bit of fear in the aftermarket. So when you write a mortgage, it typically gets packaged, securitized, and sold in the aftermarket, if you will. And if you decrease the amount of buyers of that security in the aftermarket, then the value of that security is going to go down, then there's less people that are going to buy it, which means they're going to raise rates to make those securities a little bit more attractive. And so part of that rapid raise of interest rates was the fact that mortgage-backed securities were not nearly as much in demand, and a lot of that was the aggressive tapering from the Fed of purchasing those mortgage-backed securities.
Got it. So, one of the things that you touched on was the idea of a money supply. So when rates are super low, there's literally just money pumping into the economy because the lower that rate is, the more people want to borrow it, right? And so part of the reason that inflation happens, the more dollars that exist, the less they're worth, right? Because they're less scarce.
Well, during the stimulus packages,
Right.
money was created digitally. And that was a lot of that was buying mortgage-backed securities and other ways of increasing money supply, not necessarily printing more down at the printing shop.
Right. And it's always helped me, though, to think about supply and demand in terms of dollars. Like picture actual green dollar bills. And the more of them that are out there, the less they're worth, right? And so the higher those rates are, the less appealing it is for someone to borrow those. So there's going to be less of them out there, right? So if we want to make the value of the dollar go up, i.e. curb inflation, then we're going to raise how expensive it is to get that money from someone else.
It's Venezuela in a nutshell.
Yeah, exactly. Yeah. I could run a small country. No, I could not. Ronnie could. All right. So let's talk through this then for a second. So as rates started going up, and let's talk specifically about mortgage rates. Because mortgage rates don't necessarily move with federal funds rate. There's some tie in there, but they're not necessarily the same, right? So how does a mortgage rate react to federal funds increases or rate manipulations, if you will? Like what is that relationship there?
That's a great question, and you never really know. The first time the Fed rose rates, the first big meeting they had, well, everyone kind of anticipated that they might. So mortgage rates had kind of risen in anticipation of that. And then when they rose rates, I think the first increase was 50 basis points, and the market responded in a way that said, all right, this is good news. They're serious about tackling inflation. And mortgage-backed securities started trading in a way that mortgage rates fell. So that actually, you just, generally speaking, they're going to work opposite of each other, but sometimes they'll work in conjunction, sometimes they'll go different ways. It really just gets down to, if I want to invest in mortgage-backed securities, what's my risk and what's my reward? I'm sure, Grant, you're a very smart person. You probably got a much more technical answer than I do.
I mean, if you think of mortgage-backed securities being, hundreds of loans packaged into one security and sold to a REIT or another entity, and you think of what those mortgage-backed securities looked like in 2008 and 9 with those no-doc loans, and they were, rated by Moody's at AAA rated securities when they really were, C's at best. After the Dodd-Frank Act, it made it very difficult to do these high-risk, no-doc loans. And they, subprime mortgage, correct me if I'm wrong, less than 10% of the marketplace right now, subprime.
Yeah.
I hear as low as like 7.5% subprime. So now when you package a mortgage-backed security together, it's a pretty valuable security for purchase because the chance of failure is very low. So if you look at the credit default swap rates right now, it's nowhere near what it was in 2006, 7, when those were a bunch of risky underlying loans packaged together with a couple of good loans. And so I don't remember the original question, Eric.
I don't remember the original question.
What the Fed?
The relationship between
with, mortgage rates. A lot of people, the general realtor, if you will, kind of feels like there's a 1-to-1 ratio to when the Fed raises rates, mortgages go up. And I find that mortgage rates follow inflation more than they follow the Fed funds rate. Fed fund rate is just a internal borrowing rate, overnight interest rate that banks charge each other, borrow each other's funds. And that's really all it is. And it filters through the system, but it doesn't have a 1-to-1 relationship with mortgages or housing or real estate or anything along those lines. What I'm looking at is the 10-year treasury to see where it's trading at. And historically, the 10-year treasury plus 180 basis points equals your 30-year mortgage rate in about 2 weeks. That relationship has been broken during the pandemic. It has not held perfectly true, but I can tell you this, it will return to that golden rule at some point. It just slowly but surely, right? Fear is in the marketplace. Commercial lenders aren't doing a whole lot of loans right now, so it's very expensive to do a commercial loan. But if you're doing a Fannie Freddie mortgage, what are you at 6% today?
6.3.
6.3%, and you're at 7 3/8 about a month and a half ago.
Yeah.
It's a pretty darn big difference. It's not hard to believe that we'll be in the high 5s in another couple, months, and it's pretty easy to believe we're going to be in the low 5s by the end of Q2. And we could touch the high 4s at some point this year. It would be hard for me to believe that the buyers who have been on that pause button for the last 6 to 8 months don't come back to the marketplace. And at the same time, the commercial lenders have not been doing a whole lot of loans, which means the builders have not been building a whole lot of houses. We get ourselves a little mini squeeze here, and it's just economics, but there's a possibility that happens this time around.
It's really interesting. So just some kind of banking 101. So banks fund loans through Fed funds overnight. We talked about that. So it's basically what the cheapest source of funding the banks can get funding from, except your checking account deposits, right? So what you will see in lieu of us making lots of commercial loans for 2023 is there'll be this huge initiative towards gathering deposits. And so your deposits are worth much more to a financial institution today than your loans are. And the reason is, guess how many people want to borrow money at 7%? Raise your hand. There's not a lot of you out there. But everybody needs a bank. You need a bank to facilitate a debit card purchase or a check or a wire transfer. So you have to have the financial services. In most cases, if you do business, you have to have the financial services piece. And so, the game on our side of the house is, rather than us borrow at Fed funds, which is 4.5%, if I can pay you 50 basis points, don't throw anything at me, or 1%, rather than me borrow at 4.5%, then I can make up that spread, right? So what's really confusing is everybody talks about interest rates, but there are all kinds of interest rates. And so we talk about the relationship between the mortgage rates and Fed funds and the prime rate and how all that stuff ties together. In most cases, generally, you're talking about short-term rates, mid-term rates, and long-term rates. And so we talked about the 10-year treasury tracking within a certain deviation of what mortgage rates are. So Fed funds are overnight borrowing, right? So you're talking about 4.5%, which is the cheapest. Most of my commercial rates are in the 6.5% range today. Prime is at 7.5%, which means if you're borrowing from a home equity line of credit, most all products are tied to prime rate. So I have a home equity line right now and I'm paying 7.5% on it. And I'm a banker. You think I'd be smarter than that, but I'm not. Right. So I'm paying 7.5%.
I feel a little bit better.
Yeah, thank you. Well, we're in this misery together, so
You're right.
just stay there with me. So, but if you're getting a mortgage loan, you can get a mortgage loan at 6.3. So how does all that make sense? And a lot of it's the short-term nature versus mid-term nature versus long-term nature of the rate. And when you layer in the risk, it's a little counterintuitive, because when you all, or any of us, when we stop paying a payment, the last payment we will not make, or the payment that we will
Pay
make
to the
first,
debt.
there you go,
Yeah.
that's what I'm trying to say, thank you, will be your home loan, right? Everybody's gonna pay, everything else can wait, we're gonna make sure the house gets paid. Even if the water's gonna get cut off, you're gonna make the house up. That's at 7.5% right now on a home equity line. It's at 6 1/3 or 6.3 on a mortgage. It's nuts. It's crazy. So anyway,
Well, I was just going to say that, that 7.5 you're paying right now, when you open your home equity line of credit, what were you paying?
it was 4.5.
Yeah. And so where a lot of people have been squeezed, and I like that word, and this is very relevant. A lot of people have been squeezed by, hey, rates are great. I've got a home equity line of credit that's tied to prime. Prime right now is 3.5%, 4.5%. I'm going to use this. I'm going to leverage my home equity line of credit now, and I'm going to buy a second home. Sold a lot of second homes in the last couple of years. And a lot of the source for down payment on the second homes came from home equity lines of credit. And without an aggressive strategy to pay that down, all of a sudden that money that you had maybe tied to prime at prime plus 0, prime minus 1, prime plus 1, whatever you had, now all of a sudden prime has moved in a very, very different direction.
And quickly.
Very quickly.
So one of the interesting things you guys brought up was talking about the different rates. So when we hear that, I tend to think that economics is basically group psychology tied to money, right? So this room has its own economic structure and Murfreesboro has theirs. And so what does the group think about money in this room, right? The psychology of that. And so obviously the media plays a huge role in that. And so when we watch the news and they say the Fed is meeting and they're going to raise rates, what is the rate that the news is talking about at that point? Which rate is that?
The Fed funds are
Okay.
very short term.
I thought so. I just wanted to make sure. I did used to teach economics, but it's been a while. So anyway, just want to make sure. So when they talk about that, obviously it doesn't come with this type of an explanation as to what that is and how it ties back. But what it does is it makes a lot of headlines. So what we hear is the rates are going up, rates are going up. Fed's going to meet and raise rates. It's going to raise rates, going to raise rates, all these things. And so there's a lot of fear. I think Grant used that word specifically. There's a lot of fear in the market about what's going on, and fear tends to create hesitation. Some people it's fight or flight, but really it's pause a lot of times. So what I think I've witnessed is that the volatility itself, the numbers don't necessarily matter. They do, but the volatility is what caused the most fear. What do you guys think about that? Talk to, why are people afraid? Why are people pausing? I know there's some utility to that as far as, quite frankly, you can't afford some things, right? But what else? What has driven a lot of that fear?
I'll start, and I'll just say, I think something that I would say, or it's something that I do say all the time, and you didn't say it, but you're touching all over it, is the consumer confidence sentiment, right? So how confident are we in this small bubble, or we in Murfreesboro, or we in Middle Tennessee, or the national MSA, whatever you're going to talk about? How confident are we that things are good, or that they are stable, or that they're not going to be worse? And I think the psychology that you're talking about is exactly that. So, and this is where we may disagree a little bit, and I have great conversations with my realtor friends about this stuff, where, it's like inventory drives everything. Inventory, supply, demand, and it drives everything. Well, I understand what you're saying. I'm not saying that you're wrong when you say that, but consumer confidence drives everything. It really doesn't matter how much inventory is out there. If you're scared to buy, you're not going to buy. And so if you're confident to buy, it really doesn't matter what it costs, right? Because you're like, I feel good about the job. I feel good about tomorrow. I'm going to pay what I want to pay. I know where my next paycheck's coming from. Maybe I don't want to sell. Maybe I don't have to sell. I don't care. I feel good, so I'm going to go buy. So I think it's that psychology that drives most of what goes on. But I think, and again, it's a multitude of things. But I think when we rely too much on a singular data point, interest rates, inventory, maybe even statistics, don't throw anything at me. I think we can get ourselves in a hole, and I think it can be blinders to some stuff. So, head on a swivel, watch what's in front of you, and do what feels right. That's what I would tell you. As long as doing what you feel is right, it doesn't kill you. So.
I don't necessarily disagree with the general concept that consumer confidence really drives most buying decisions, or almost all buying decisions. And it is at historic lows as we sit today. And I look at other things like what the St. Louis Fed is tracking with the personal savings rate being also pretty close to historic lows. And then I look at the credit card data being at historic highs in terms of what is being driven there. But then I look around, and I think that what I'm waiting for is the R word. I'm waiting for the Economic Council to finally have their meeting and say the R word, and say that we have been in a recession for X number of months. We've been in a bear stock market for 9 months now. The average recessionary stock market lasts 14.5 months. That's taking into account all the deepest of the recessions and the light. Officially, we were in a recession in 2020 for, 2.2 months? Something along those. But it's taking into account all of those. So I feel, though, that you have to take into account the group psychology piece of this as well. When my neighbor Dan goes and buys a house a couple of months from now for $450,000, and I say, Dan, you're a moron. Like, this is just the worst time ever. I have no confidence. Credit card off the charts. Consumer confidence is so low. There are words coming. And then 2 months later, my friend Susan buys that same house and it's $455,000. I turn into a lemon. So that group psychology piece of it can't be ignored. Jonathan and I talked about this a little bit. We do live in a little bit of a bubble in Middle Tennessee. And that doesn't really have anything to do with being in Middle Tennessee as it does to being in Tennessee. a very business-friendly state, a income tax-friendly state, a state in which at almost all levels of government, they're working very hard to bring in new jobs, new industries. And so we constantly have this nagging little optimism in the back of our heads that you can actually energize pretty quickly. And so with the commercial bankers not really loaning a whole lot on new projects, and with a couple of buyers that have been on the pause button for some time, I, again, towards the middle of this year, would not be very surprised to see this price deflation that we're currently in. We've been in for 6 months in the residential housing market. I wouldn't be surprised to see that plateau at the bottom and then start coming back up for the rest of the year. And all of a sudden, my neighbor Dan bought at the exact right time, and then I'm the idiot on the outside looking in. It's also important to say that a lot of the institutional buyers have also hit the pause button. So we sort of vilify these America's Homes for Rent guys and BlackRock, but they do drive our market pretty hard. You saw what they did in the Spring Hill marketplace over the last decade. They own over 4,000 houses in Spring Hill between all those guys. And they've been off the buy button for a while, but they've been accumulating cash, have records amount of cash on hand. They're money managers. They have to put it to work or they have to return it. What do you think they're going to do? They're waiting for the right time to deploy that capital. I wouldn't be surprised if by this spring and summer, all of a sudden the institutional guys are back on the buy button hard. And now my neighbor Dan's got a house, but all of a sudden I can't get a house now because the institutional guys are back. So there are a lot of dynamics outside of consumer confidence, but I agree. Like when I go to your store and buy a dozen eggs and it costs what it costs, I get pissed. I'm not happy with this at all. But I think to myself, all right, what's causing this? Is it just inflation? No, it's avian flu that really, and you got to think through all these factors. And so the housing market feels similar to me. Now, in the commercial office space, I'm not nearly as rosy at all. I feel there is a contraction coming for maybe decades, just because the way that we work is now very, very different. I actually closed my office in 2018. I don't think I'll ever reopen an office because now you can do everything you want to do through Zoom, which didn't exist then, but now it's perfectly acceptable to do Zoom. And so those fundamentals have changed, and I think that rising tide raises all ships. So lowering tide does the same. So that's going to hurt the real estate industry a little bit as well. But long story short, I'm a little bit rosier.
It really doesn't matter, guys.
All right, so what are we talking? What's the latest question? Because I have some things I want to say, but
We're talking about consumer confidence and just how that drives things. And we brought up, all sorts of stuff has been brought up. We brought up a little bit about the Nashville MSA being insulated. Grant brought up some stuff about historic low savings and historic high credit card debt, and how that all plays into that consumer confidence. Ronnie's contention is that consumer confidence basically drives our overall economy more than any one single factor, though there are multiple factors at play.
So that's kind of what I was thinking we were on. So Ronnie mentioned the consumer confidence being the biggest driver, and you're watching out. So you're watching that report. You're waiting for the R word to drop, and
it will.
It
should.
Probably should have already.
Right.
What I'm watching is the job losses. So like when we're looking at layoffs, how is that playing in? And that's where I think the consumer confidence is. It's low now. And we haven't really experienced a lot of staffing reductions.
But we added jobs overall.
220,000 in December.
But if we get to a spot where we're seeing a lot of that, and that's what I think this whole market right now, this whole economy do we get through a recession without job loss? And if we can get through the recession without job loss, we're going to be okay. Everything is going to be
short.
fine. If we get into a job loss situation, then it's almost like lemmings or the first domino that falls, and then all of a sudden, well, did you see that Amazon laid off a bunch of people? We need to do that. And we're at Oracle, by the way. Guess what? These are companies that have invested a lot of money in the middle of Tennessee. And I used to always feel like that Middle Tennessee was insulated. We have this bubble over us because of how much head of steam we have with companies coming here. But what if those companies that are coming here are some of the first ones to kind of lead that foray? And now we have people who live here, very educated, very specialized skill sets, who may have to move out of here to go back to where they came from to find work. Just a thought, just something to think about.
We're gonna switch gears just a little bit because I do want to make sure that we cover a couple of these things. So talking specifically about housing and that kind of thing, Grant started kind of talking about this. You know, the big question as the market heated up over 2020, 2021, and into 2022 a little bit is, you know, are we building a bubble, right? We kept hearing that. Is there a housing bubble? Do you think there's a bubble? Do you think it's going to pop? You know, am I overpaying for this house? That's really what the question was about, right? As we wrote an offer for, you know, 10,000 above list or 20,000 or 50,000, we got beat out. Brett had one at the time. He wrote, I don't even remember now, like 60K over, and got beat by somebody that wrote 100K over, you know. And did those people, so multiple questions here, did people overpay for houses, right? Practical question, did people overpay for houses? And is there a price bubble? And if there is a price bubble, is it gonna pop, or has it already, or like where are we in that?
I'll go first. I haven't done that yet, I don't think. So did people overpay? I don't know. The appraiser's least favorite question is, we've got a willing buyer and a willing seller. So to that point, maybe they didn't overpay. Comps got reset weekly over the last couple of years. So I don't know that people necessarily overpaid. And Grant alluded to this a few minutes ago, the credit quality is so much better than it is now. So and this goes to my point about job losses, if I can keep my home that's at 3% on a 15-year, 30-year mortgage and stay in that house, I'm going to do it. I'm going to figure it out. I'm not, and especially if I have the potential for that big of a loss, if I'm that upside down. If I'm that upside down, I might just go give the keys to the bank. But if the sales prices stay consistent and I don't find myself too incredibly upside down, I've got a great rate, I've got an affordable payment, and I can tap into reserves, tap into long-term saving strategies just to weather the storm and keep my historically low mortgage rate. When everybody doesn't think that, or nobody thinks that mortgage rates are going to get down back into the threes, then I'm going to do everything I can to stay in that home. So to me, it really just gets down to that. I don't think that people overpaid because that was what the market required at the time. And the fact is, a lot of those deals were huge equity outlays from a departing residents. So they've got pretty good skin in the game, got good credit quality. Ability to repay has been proven. So as long as they can keep their jobs, they're not going to sell in the foreseeable future.
I think the only thing I would add, so for those of you all that know Warren Buffett, one of the things Buffett will say is that, you know, if you've got a long enough time horizon and if you're not interested in selling, it really doesn't matter what you pay. And so I'm not going to tell you it doesn't matter what you pay for a house, because it does. There are situations where things happen, life events happen, people have to move, jobs, divorce, whatever else, and you're forced into a sale of a home. I think, generally speaking, even though we had really rapid home appreciation in 20 and 21 and in 22, for the most part, I think unless you are forced into a sell scenario prematurely based on your plan, or you didn't have a plan, there are lots of times people don't have a plan, but they just want a house. But unless you're forced into that, I think the time horizon matters more than anything. So if you're not forced into a scenario where you're buying and you're selling 24 months later, I think you're fine. If you are forced in that scenario, I'm going to say, heck yeah, you overpaid. You're going to get smashed. That's what's going to happen. And so with that being said, that does not mean that, as we were talking earlier, that you could be sitting on the fence, and if you had not bought, then it could go the other direction. And so you're not day trading your home, is what I would tell you. It's a long-term investment. It's the largest investment most people will make. And so I would say, as long as you're prudently purchasing and you have a plan with what you're doing and you treat it as a family home and not an investment, I think you're fine. For those people that are speculating highly in the real estate market, you have the potential to get smashed. If you think you do not, then you're blind. And so I'm not telling you that will happen. I don't know that that would happen. If I knew it would happen, I wouldn't be doing this. I'd be somewhere else. But the potential is certainly there. I think caution is always, prudence is always a good thing. You do need to be cautious. And I think that's all I have on my topic.
Yeah, I would say bubble, no. I mean, if you think of the housing market as a balloon, it is just, when you say it's a balloon, that you think an overinflated thing and you prick it with a pen and it explodes and everything crashes. That's not where we are. Is our balloon inflated more than it should be? Probably. And some air has been leaking out of it for the last 6 months and will continue to leak out of it, but it's not a pop type situation that we're looking at here. I would say that, the second home marketplace is the place where there's going to be the most volatility. So if you bought a second home in Rosemary Beach and paid $5 million to be 3 blocks off the ocean, that's going to lose a heck of a lot of value, a heck of a lot more than your house in Murfreesboro. And so Nashville not necessarily being a massive second home market, the whole MSA area doesn't necessarily feel overinflated or all that risky in terms of being a balloon. But people's ability to purchase houses really depends on, their mood, the psychology of the situation. Can they afford it? Do they think they'll have their job for the next year or two? Do they feel stability? And again, we're very lucky to live in a Sunbelt state where we have a heck of a lot more consumer confidence than someone in a Rust Belt state. If you're in Illinois paying crazy high income taxes, property taxes, with the issues that their pension funds have, you're probably a lot less optimistic than someone living in Tennessee, Florida, Texas, Arizona, Sunbelt states. So we have to look at some of those national statistics a little bit through local lenses, because I do feel like those Rust Belt states, the West states and the Northeast, are driving that consumer sentiment number down. So are some of those markets in a bubble? Yeah, it's a little bubblish. Is our Middle Tennessee in a bubble? Slightly inflated balloon with air leaking? Yeah, I think I'll take that.
I would agree with that. Let me add, if I can, one more thing. I do think one of the things that we've talked about related to overall market stability is there an inflated price for these homes? When we were talking about credit quality earlier, we were talking about consumer spending, consumption, credit card debt, that type of thing. One of the things that's a concern for the financial institutions, and I only know Pinnacle, you can pull financial reports on other financial institutions at the FDIC website, you can get this data. But let's say Pinnacle Bank has $1 billion in loans, and at the end of the fourth quarter of this year, we had $1 billion in loans. In relative terms, we had 0 past dues. Imagine that. So here's what that tells me. It doesn't tell me I'm any smarter than anybody else out there or we're any better than anybody else. Now, client selection is extremely important. Who you choose to lend money to is extremely important. What I would tell you is there's a tail that's coming that we haven't gotten to yet that's propped up some by the credit card spending. People may be paying their mortgages by tapping into credit cards. They may be spending, using their paycheck to pay their mortgage and spending their personal spending on credit cards. So I think that gives me the reason to believe that there's more stuff coming, because until our past dues go up, we're planning for those past dues to go up, and until people start defaulting on commercial lending and commercial loans and residential real estate loans, I don't think you get to the end of this until you really start the bloodshed. And I personally, I'm the naysayer of the group over here. I just don't.
No kidding, I'm impressed.
I'm sorry. We can have a beer. We'll get you a beer. It'll be good. I don't think the worst has gotten to the shed. Now, I hope that does not happen, but how much sense does it make that we had 0 past dues on $1 billion in loans? It makes 0 sense.
Yeah, that doesn't. You're right. Okay, so one of the terms that we've used a whole bunch, at least I have in conversation, my team has in conversation with folks, is when they ask about what's going on with the market, housing market specifically, some people will say it's slowing down. Some people will say it's stopping. Some people will say it's, whatever, right? The term that we tend to use is normalizing. And so from our perspective, what we've said is, a $50,000 above asking price offer on every single house that you write an offer on is not normal. Waiving appraisals is not normal. Waiving inspections is not normal. Never being able to have a home sale contingency is not normal, right? And so we're returning to a more normal, functionally type market. That being said, why haven't prices tumbled as quickly as they went up over the last couple of years? Why? I mean, I know we've seen, Grant will go into this, I'm sure. We've seen a little bit of price deflation, but it hasn't matched the pace. And why do you think that is?
Well, again, it goes to one of the first things. There's a lot of reasons. I'll just take one. If I bought a house in the last 2 years, or if I owned a house in the last 2 years, there's a good chance I have a really, really low interest rate. So I don't have any motivation to sell my home unless, like Ronnie mentioned, I'm forced into doing so through a divorce or a job relocation or some significant changes, maybe not be able to afford the payment any longer. So that's keeping inventory a little low. There's not as many homes on the market because where would I go? What would I go do? Well, why would I leave the mortgage that I have right now with terms that I absolutely love to have me set up for a great long-term financial plan? So I don't have any motivation to sell my house now, even if I feel like my family's growing. I might stay in this home instead of, hey, we got another kid on the way, we need to go buy another house so I can get out its own bedroom. These two can bunk up for a little bit. Until they get a little bit bigger, we don't have to go buy the next house across town. We're going to stay put. And I think that's just one reason.
Do you have another kid on the way? For real?
No, I really don't. It was
Breaking news from the Nail household.
I was just saying.
Congratulations, Brian.
Yeah. I'm calling Eric a surprise.
If you look at home prices, right, they're not it's not a straight line. You're going to get deviation to what happens in terms of appreciation and depreciation. And for the most part, home prices really haven't appreciated very much at all, except during the Great Recession recently. All the other recessions haven't really been real estate led, and so home prices stagnate. And so we're in that stagnating point in time where everybody's on the positive. And why would you sell? I mean, I put a 2.5% interest rate on my home. Am I selling that home anytime in the near future? No. I could not replicate that and likely wouldn't be able to in my lifetime unless there's another global pandemic with another administration in place who lowers the Fed funds rate to zero and all the banks panic in the exact same way, which will never happen. And so there's a lot of people that have interest rates at 3.25% and below who are going to hold on to those, and those are going to become legacy properties. They'll become rental properties for them, and they'll move on and buy another property. It'll never come back on the marketplace. That's a lot more houses than you think it is. A lot of people refinanced in 2020, which is when that rate was really available to you in that summer of 2020. They didn't even have to purchase it. All they had to do was refinance. And some folks refinanced and got a HELOC on that. And it's the HELOC that's causing the pain, which is causing the commercial banker pain over here. And I get that, right? Because our business on the residential side is a heck of a less stringent, if you will. Like we've got Fannie Mae and Freddie Mac that bail us out of every poor decision we've ever made. You don't have that on your side. And so you're dealing with the real world here, and you're having to write, commercial construction loans at 7.5% and 8%, which nobody wants to do. But over here, he's going to write you a 5.9% purchase money loan in a couple of weeks, and you might do that. And you sure as heck will when it gets down into the lower fives. Because it's going to feel good, right? Because we're used to hearing that 7.25 and 6 point whatever. It sounds terrible, but 5 point something feels good. we did some math. During the Great Recession, buying stopped just over 6.5%. So when the mortgage interest rate, 30-year fix, got about 6.65%, that's when buying kind of stopped. This time around, we did the same math based on where prices were just before Thanksgiving. And buying should have stopped at 5.34% if the same economic conditions existed, but it didn't. It kept going up until it got into the higher fives, and then it kind of stopped. Which tells me that if prices come down somewhere between 6 to 9% off the peaks, and interest rates settle in around 5.5% at that time, that we might be at a new equilibrium. It's a new floor. And so if you're looking at the price, in 2021, 22, and then you hit this equilibrium point, and then from there you're back up again. So that's where a lot of our rosy optimism comes from. That and the fact that commercial bankers just aren't loaning loans to build new houses, new subdivisions, new dirt work, new anything. A lot of, I deal with First Bank a lot. I had lunch with one of their larger bankers who has a $500 million portfolio. And she told me she's not writing any new loans until Q3, maybe Q4. No new loans. I don't care if you pre-sold 100% of your new project, we are not loaning you money. And that's shocking to me. So that tells me demand may be there, but the supply may not be able to meet the demand. And so in the residential world, it's going to get interesting. It's kind of the opposite of the office world, right? If there's a heck of a lot of supply all of a sudden, and the demand has spread out and gone wherever the heck it's gone. And so what does that look like in the next 5 years? I don't know. My office broker friends don't call me back. I'm not sure.
Yeah, I think the only thing I would add is that, I tell people all the time, I can only answer the question based on what I think I know today, because tomorrow we may have a new data point and it may change what I think. But with that being said, I was arguing that consumer confidence earlier. I was arguing that consumer confidence is the most important data point, and I do think that. But inventory is a really important data point as well. And so when we talk about how much prices have come down and how stable they will be, I think the limited amount of inventory that we have will provide some price stability. I think there's probably more, and this is purely my opinion and me guessing, I think there's probably more downward pressure on it than we see and we feel, and I think it's because of the inventory situation. And so the other thing, if you don't know how to use a financial calculator, or if you don't have a friend that knows how to use a financial calculator, do some quick math and look at the difference in purchasing power from a 3.5, or let's just use 3% mortgage rate to a 6% mortgage rate, and look at how much money you can lever, right? So if you had 3% and your payment was $1,200 and now you're borrowing at 6% and you can use a $1,200 payment, how much can you borrow? How much can $1,200 lever at that rate? It's pretty profound, really profound. And so why do I bring that up? Banks, when you talk about us, because we're risk managers and we're all scared to death, right? So we're afraid to lose money, we don't want to lose money. And so if you want to borrow our money, you have to deal with our issues, and our issues are we're afraid right now, we're scared. And so why is that important? Because one of the reasons that banks will just stop is we get into a situation where we have to, in our underwriting process, that 3% rate we were underwriting your cash burn, or your debt to income, or all your financial ratios is now 7%. You don't qualify the way you qualified 6 months ago, 9 months ago. And what we also know is 3 months or 6 months or 9 months from now, you're probably going to qualify even worse, right? It's not going to look good. And so for us, what we have to do, and this is what happened in the Great Recession in 2008-9, you heard assets being marked to market, where we basically had to come in and tell people, you need to write a check because this asset is no longer worth what it was worth, and we made a loan to you based on these variables. And those variables don't apply anymore. And so part of the reason that banks have pulled back this early is because we're not sure where this thing is going to go, and we don't want to knock on the door and say, write a check, or we don't want to take the keys. We don't want to do any of that. And so I think it's more important, and this is one of the great things about this event, it's really, really important that you have people that you trust, whether it be a real estate individual, whether it be a banker, whether it be a mortgage banker. Use the resources that you have to ask questions and to get information like what we're doing today, because it really will help you make a good decision about what you're doing and understand to the degree we can have insight into what's going to happen in the next 3 to 6 months. Because the truth is, nobody really knows. We're all guessing. Now, some of us are guessing better than others, I would hope, but we're all still guessing.
That's true. All right, I got 2 more questions that I'm going to ask them, then we're going to open it up to you guys asking questions. I wouldn't be doing my job if I didn't pause for a second and ask you to do this. If you've enjoyed the information or you've gotten anything out of this, if you don't mind, do the J. Harmon Home Team a solid and take a picture and put it on your social media and tag us in it. That would be fantastic if you could do that. You're allowed to have your phones out for that. So that's it. That's the teacher in me right there. All right. So next thing I want to ask, we're gonna go this way and then we'll open it up to questions. All of these things going on from the seat that you're in now, from your perspective, what are the opportunities in 2023? Where is there opportunity? I've got guys in here that are buying houses. I've got people in here that rent houses. I've got people in here that own houses. What are the opportunities that are going to present themselves in 2023? Don't start with Ronnie, for God's sake.
I wanted to start with Ronnie so we can lift it back up.
That's maybe a good idea, yeah.
Okay, I'll be real quick on this. I would tell you, I think there's a saying in real estate, you make money when you buy, right? Not when you sell. And so I would tell you it's more important than ever to pay attention to that because of the cost of borrowing, especially if you're using leverage. If you're using cash, it's not as big of a risk if you're using your own liquidity to buy something. If you're using the bank's money, you better be real careful. You better buy right. And whatever return you're getting on those investments, notice I'm not talking about buying personal assets. I'd be a little concerned about buying personal assets today, especially second homes. Probably wouldn't do that. Of course, it's 6.5%. Most people probably aren't doing that. But I think how you buy is more important than ever in a market like this.
So in 2018, rates started to inch up a little bit. They got up into the 5s and the market slowed down. And I had a lot of my realtor friends who asked me to help them come to open houses, asked me to help them, market their homes that they had listed so they could sell them. That didn't last very long before mortgage rates came back down and we went right back into the seller's market. So I think we're for the first time in quite a long time, we're in a little bit of a buyer's market right now. So I think if your long-term strategy is home ownership for you to live in, this may be the best window you have to buy in a long time. Programs like 2-1 buy downs, permanent buy downs, in the last couple of years, it didn't make any sense to pay points to buy the rate down because rates were already so low. Where they are now, it might make sense to do that. And guess what? If we're in a buyer's market, you can have a seller pay that. You can negotiate that. You can go look at 5 or 6 homes, 7 or 8 homes, and decide which home you want to raise your family in. You hadn't been able to do that in a few years. So if you think you want to buy a house this year, I would not wait because I do think rates will come down. When they do, you can refinance. But I think right now you have the opportunity to buy your home at a place where you may have a seller who's highly motivated. Maybe for some reason they do have a reason they have to sell. Maybe they're moving to West Tennessee. Maybe there's a divorce. Maybe somebody's passed away and they're trying to sell the estate. So right now, maybe the buyer's market that you haven't seen in several years and may not see again for a long time due to the inventory reasons I mentioned earlier.
The biggest opportunity is going to come from over-leveraged builders and from DDJs, death, divorce, and job loss. That's what you're focused on right now. The average family is not going to sell their home at a loss. They're not going to sell it for less than market can bear. So you're looking for over-leveraged builders, those who Rob Peter and May Paul wanted to get big, they grew without equity, and they grew on lines of credit and other investor equity. Those are the ones that will feel some pain, and they will go down. There will be builders that go back to the bank. There's a couple in Nashville right now that probably have 15 to 20 houses each that were individual builders who were probably going to give some of that stuff back to the bank. That's one of your best opportunities. Some of the big builders, I happen to have a good friend who's a area manager for one of the biggest. and they still have to meet their quota. In their division, they need to sell 45 houses a month. And when it gets towards the end of the month, they've only got 30 booked, guess what they do? They incentivize the ever-living crap out of it. And that doesn't necessarily mean price, but that means huge buy downs, that means huge upgrade giveaways. So if you're gonna buy a house from a builder, wait until the end of the month, go in that last 4 or 5 days before the 30th, and you can usually rip those national builders a new one and get 3, 4, 5% worth of stuff. And that won't last forever, right? Because they're still worried about their lot takedowns, right? Because their commercial bankers are all calling them, oh, you're still on track to do your 15 lots this next quarter. And so they're freaking out a little bit too. And so they've got to keep turning and burning. So there and your DDJs are where you're going to get your best value from right now. That's not a ton, but that's where your best opportunities are right now.
Got it. All right, last one, and this is a little redundant to what we just did, but this is how we'll wrap up this portion, is pick or do both, whichever. What's the best advice that you could give a buyer or a seller, a residential buyer or seller, or both, right now? Best little nugget, single nugget.
For me, it's who you know and who you choose to work with. Everything else, the rates are going to be, we're all mortgage bankers, we all sell our mortgage securities to the same investors. We're all probably going to be priced pretty close to each other. Now, there's no reason somebody may have a better rate than somebody else one day or the other, but build your team with people that you trust, that are going to give you the right advice, whether that's to hold tight or go now and go as fast as you can. That's the biggest thing, just a solid team, not just who you like the most, not just who you think is the smartest, but who you trust to be smart and to do right by you.
I like Ryan's answer. I think I'm going to use his answer, but I think the other thing I'd be careful about is there are those that need things to be better than they are because it helps them for things to be better than they are. And so I'm saying the same thing that Brian's saying, but I do think a trusted advisor is someone that you trust and know and believe, rather than, everything's going to be fine. Don't worry about this, whatever else. I think you need to be leery of those folks. I think someone that tells you, hey, I'm optimistic. Here's why I'm optimistic. Do I really know? No, but based on this information, I think you're going to be okay. And I think based on your individual circumstances, if you were buying to sell in 12 months and somebody's encouraging you that everything's going to be great, you need to be real careful who you listen to. But if you're buying a home and you're saying, hey, this is where I'm going to raise my family, I wouldn't be concerned about that. If you told me I was going to be here, what the average mortgage note is 7 years, 7.5 years, 8 years. I mean, over an 8-year time horizon, am I concerned about what's going to happen in the real estate market? No. So I think, just like we try to choose clients, people that invest and borrow, I think advisor selection is really important.
For buyers, I would say if you're going to buy new construction in the suburban market, go the last 3 days of April, negotiate the living heck out of it. That statistically points to the best absolute time. It could be pushed to May, but the last 3 days of April should be the time if you're going to go buy new construction from a larger builder. To echo what they say, we say this a lot. Never work with a realtor, mortgage broker, a banker, or a financial advisor who lives paycheck to paycheck. They're just never going to give you unbiased advice in good or bad markets. Always work with somebody with a track record who's not in any kind of financial duress themselves.
That's good advice. Good advice. All right, open the floor up. Who's got a question that they would like to direct to someone? Yes, sir.
All right, so we've talked there's been a lot of conversation around what I'll call the experienced buyer or the experienced person. What's the thoughts on the entry levels? I mean, when you start thinking about those people that don't have the career, just starting a career, or don't have the personal wealth to come from a sold in California, moving to Tennessee kind of people, what is the thoughts around that? Because the REITs, Real Estate Investment Trust, are buying up anything that's, I'll call it 250 or below, and really makes an entry-level property almost out of reach for somebody coming in. So what's some thoughts around that?
So for the last few years, they've been beat up by not having the money to make a down payment. But that's kind of gone by the wayside now. I'm seeing people have FHA and THJ offers get accepted because of the market that we're in now. That's another thing that may not last. If by the end of this year, by the middle of this year, that market might have changed. Now, we can get into an affordability conversation, and the fact is, with a lot of those first-time homebuyer programs, they do have a little bit tighter restrictions on debt-to-income calculations and ratios. So while those programs may be on the table now, it can be a tight squeeze to find a home that they can afford, not necessarily afford, but feel comfortable. Because I've talked to a lot of people who have approved for the payment, but when they heard what it was, they decided just to stay put. And then some of those people were already homeowners that said, we're going to stay, we're not going to make the move.
I think the entry-level buyer is somewhat insulated, to be honest with you, from risk associated with fluctuations in price. So, I mean, I'm seeing much more fluctuation in that $500,000, $600,000, $700,000, $800 million price range, or $5 million price range. I think in that 200 to 300 range, in that area, the pyramid is so wide related to how many buyers there are in that area. I think it provides more stability, and the REITs themselves that are buying, I think it provides more stability at that price point. So I think the biggest risk would be whatever down payment you're sourcing, because usually at that point, most people are not selling a home to source a down payment, which they do for their second home, right? They're saving, or parents are giving them money, or there's been some sort of liquidity event that's happened in their life that's created that opportunity for them to get that down payment in their home. I think the longevity of that, meaning that, are you buying a house because you don't want to rent? That might be a dangerous game. Are you buying because you have a family and you plan to stay for a period of time? I think you're probably safe. But I think there's less risk in fluctuation at that price point than I do at the higher price points.
Yeah, I feel badly for that market segment for all the reasons that they stated. The cost of build has risen 30% in the last 2 years. And so a lot of those folks were priced out, not necessarily by the actual demand, but just by the fact that what it costs to build and what the land costs to develop made the math not work out for those folks. And I feel badly mostly because, you develop so much of your wealth through the ownership of real estate. And mostly that's indirect wealth. It's not necessarily direct, like I sold my house for $30,000 more, now I'm $30,000 richer. You start learning about things like mortgage interest deduction, and things start to come together for folks when they have a home ownership, right? Psychologically, it truly is the American dream, and it's been out of reach for all those reasons we've talked about. I do think, though, that land prices have driven that affordability piece and the cost of construction have driven it so far out of reach. Builders want to build for that market segment, and the REITs don't necessarily want to buy that super entry level. Most of the ones that I've talked to want to buy those 4-bed, 3-bath, 2-car garage houses that are $450,000, $500,000 that are in good school districts. They're going to rent for $2,500 to $2,700.
Do you live in Tennessee? Middle Tennessee?
No, yeah, this is
4-bedroom, 2-bath for $400,000?
Yeah, I know.
Come on now.
I know. I mean, but that's what they want, right? They want under $500,000. They want 4-bed. They don't care how much land it's on, and they used to care what school district it was in. Now they don't care what school district it's in. So you see them out in Christiana and other places now doing these single-family home for rent neighborhoods that you never used to see before. When they would only be in a school that was rated 5 or above. But I do think land prices have to come down for those first-time home buyers to really be able to get back in. And those home buyers may need to recalibrate to less of a single-family home and more of a county, perhaps, for their first foray into real estate. And so a lot of municipalities have not been aggressive enough with rezoning for density. And those municipalities aren't going to attract first-time home buyers, and that's a shame.
Thank you.
Damien?
Thank you. Two-part question, and one is the Fed rate. Do you see the Fed rate continuing to rise throughout 2023? And then the other part is, I think you mentioned that even though the Fed rate goes up, sometimes the rates can actually go down. And how does that work?
That's exactly what's forecasted for this year, actually. The forecast, and the Fed tells us, we know what they're telegraphing their moves. They release minutes right after they meet, and they told us they expect to keep rates on the move up through the second half of this year. In early last year, when they started to raise the Fed funds rate, they told us the first sign of inflation getting better, we're not going to lower rates. Because that's what happened in the 80s, or late 70s, early 80s. The first sign that inflation was on the way down, they cut rates and inflation came back like a two-headed monster. So they're going to be very intentional with making sure they have it under control where they want it before they start to do any kind of easing of rates. Now, mortgage rates are, again, they're not driven necessarily by the Fed funds rate. They're going to be driven more by the 10-year Treasury. And so that's what's going to be tracked for mortgage rates. Grant mentioned it earlier, the 180 basis point spread about 2 weeks out. I think that at some point this year, we're going to get more towards that. One thing that we didn't get to mention earlier that I thought was really interesting that I do want to share is at a certain point this past year, mortgage rates had risen so high that you couldn't get a par rate. And what that means is the mortgage bankers had to charge discount points just to get a rate that an investor was willing to buy, because investors were looking at this and saying, nobody that's doing a mortgage at 7% is going to keep this long enough for us to make our money back. They will refinance this before we will make our money back on this investment. So you're going to have to give us some upfront fee income to deliver this mortgage to us. And so that's the market right there predicting that rates will fall before they can make their money back on those higher mortgage rates. So that being said, I think that we will see our mortgage rates come down this year. I think very much alike with Grant. I don't know that we'll see the fours, but I think we'll end this year solidly in the fives. And we've already started that move. We're getting pretty close to a 4-month low in 30-year mortgage rates right now. With a couple of days of good activity, we'll probably hit a 4-month low.
That's the same with commercial?
No. Running.
Yeah, I think again, it goes back to kind of time horizon. So I would tell you that we'll probably have another increase or two. And I think the prime rate, which of course pivots off of the Fed funds rate, it'll probably be 8.25, 8.5 by the end of the year. Lucky me. But
That's the question.
yeah, right. It is depressing. But the other piece of that is, I think what the market's telling us, and this is what Brian's talking about, is that that's a short-term issue as we're combating inflation, right? So we're still trying to get inflation, still trying to pull inflation down. So they're going to continue to put upward pressure on that short-term rate, because that's what commercial rates generally are, short-term rates. Because the 30-year rate tracks, or mortgage rates typically track the 10-year Treasury, you've got this inverted yield curve that everybody talks about, where your short-term borrowing is higher than your long-term borrowing, which is unusual. You know, you usually say, well, if I only need the money for a short period of time, I should get a discount rather than me having to pay more money for a long-term rate. And that gets into the, I don't want to take this further than it needs to go, but we start talking about the premium pricing of bonds and the rates and the value, the par value. So interest rates go up, bond prices go down. So you start talking about that mechanism. But I think the short answer to what you're asking is commercial rates are driven by short-term borrowing, and the mortgage rates are more long-term borrowing, which is why when the short-term rates go up, that long-term rate may continue to go down, because consumer confidence, and I think people that are not smarter than them, but smarter than me, know that we're going to be back into a more normalized 30-year conventional rate, because we have to be. I mean, because they're not going to tank the thing. They're just not going to let it tank.
Yeah, so the Fed telegraphs everything they do. Jerome Powell has said over and over again, they want that annual moving rate average for inflation to be 2%, 2.0, right? right? And we are in the lower sevens right now, down from high eights. So we've crested, but they will not be happy at 6%, 5%, 4% inflation. So the only question is, they meet 8 times this year. Next time's on February the 1st. The question is, how big is the basis bump? I think right now we all think it's going to be 50 basis points. But the jobs numbers came out at 220,000. It comes through up 0.4%. That's terrible for inflation. Absolutely terrible. Is there a chance it could be 75 basis points? Little chance, but there's this wonderful little website that I forget the name of it, but if you Google Wall Street predicts Fed funds rate bumps on Google, you'll come up with the first one. It's all these fund managers and all these stock traders and stuff voting on how big they think the increase is going to be. And they're 6 for 6 right now on that. And so when we thought, that second increase was going to be at a 50 basis point, end up 75, those guys had it nailed on there. There was at one point a few months ago, we thought we were going to get a full 100 basis points, and we got 75 instead, and those guys nailed it. So that's a good place to go if you want some predictive analysis. But again, I think we're probably seeing 3 to 5 increases this year, probably a decreasing value, so probably a 50-50 at 25, maybe at 10, and then hold par and see what happens. But inflation can derail not just an economy, but a society so fast. You can see that in Venezuela right now. You can see it happening in Brazil. It has to be controlled. And shrinking the money supply is another way to do it. So the fact that they're not buying the MBSs any longer is going to speed that process up without having to raise interest rates as high. But there is a fun side effect. If you do have money sitting in the bank, go get yourself a high yield savings account. I bank at Regions Bank, so sorry to anybody who loves Regions in here, but I took all my money out of Regions Bank and put it into a high yield savings account. It's paying 4.3% interest right now, compounding monthly. And I can go get that money anytime I want to. So this is good.
Ronnie, what do you have to compete with that?
Wow, look at the weather.
Well, look at the time.
So
It's hot up here. It's getting real hot up here.
there are always ways to sort of win in any economy, if you will. And so as we deflate a little bit, as we recess a little bit, there's a way to make some money with your money right now and stay on the pause button until it's time to buy something. And it's residentially not too far to buy something. I wouldn't go buy downtown, buy an office building in downtown, go buy the Batman building, probably the worst investment you can make. So there's always opportunities in every market, I think is what I want to leave you with.
2 things you said as we recess a little bit. Man, I used to love recess. This one doesn't sound
It was the
fun.
best.
But another thing that you said that incomes were up and job reports were good, and that's terrible. And I think that needs to resonate. Like what the Federal Reserve wants.
Terrible for inflation.
Yeah, but that's counter to what the Fed is trying to do. They want a little bit of pain. They want a little bit of shrinkage in the economy. And so I want to make sure that people heard that and that resonates, so that it's understood by as many people as possible. That's the goal, to get inflation under control. That's the goal. It's gonna hurt for a little while, and all of us hope that it only has to hurt for a little while, not for a long while, and not real bad. Just a little hurt for a little while.
Yeah, soft landing, right? That's that term you keep hearing, soft landing. That's where we all want to get to. Just how do you steer the ship into a soft landing when there's no instructions on how to do that? And it's never really been done well, ever. And the Fed intervention in monetary policy is relatively new. Fed didn't really manipulate rates until about 30 years ago. This is a relatively new thing. It's not been happening for all 200 years of our country. This is new.
Any more questions out there?
This is projected.
All right. So one last thing. Oh, we got one?
I do, it's a little bit of redundancy, but for the slower people in the room, I love how you said that when you're thinking of taking money, consider what you're buying and not what you're selling. But how does that, what should I look at the most? What should I focus on more, the interest rates or the home sale price? Because both of those keep taking my attention.
So you can always refinance your interest rate. You can't go back and get that house for a cheaper price. So there's one thing I'd say to answer that question. I've mentioned that there's loan programs that are back, loan programs we haven't seen in a long time. And one of those is there's a lot of lenders now who are offering some form or fashion of a heavily discounted refinance once you've been in the home for a certain period of time. So if you were to buy a house now while it's more of a buyer's market, and rates are higher later this year, I'll be glad you got it when you did. If rates are better, you'll have the opportunity to refinance that. So to me, I think you make your money on the buy with the price of the asset versus the interest rate, because interest rates can always be revisited at some point in time. You would like to be able to accomplish a refinance.
That's brilliant.
Yeah, it goes back to location. You guys have heard that for 30 years now. Look for a higher growth area where you see growth over the next 10 years in terms of population. That's really what it comes down to. You'll never be able to predict the next pandemic or the next time that interest rates go to zero. And it'll never happen again in our lifetimes likely, right? This is a once in a generation event kind of thing. And so I'm back to looking for areas that are high growth, that can support a rental. If you're talking about investment property, they can support the rental rate now, where you see value increasing in terms of population density. Just proximity matters again, right? It felt like it didn't matter 2 years ago. Just buy whatever, whenever, because the rate was low, and you just thought the rate would drive value forever. Just back to fundamentals and stick with high growth areas, good locations. And it can be not the prettiest penny in the bag, but you can always shine that penny up. And you can redo your rate 47 times over 50 years. I mean, nothing stops you doing from that, but you may never ever get that location.
Yeah, I agree. I think the only thing I would add is there's a concept in investing that's referred to as dollar cost averaging, which means you continue to buy even when things go up and go down. So you're getting ownership and you're just paying more or less for your ownership along the way. But over time, you average out all those purchases. And so if you're going to have a large portfolio, you're going to buy multiple assets, I would tell you it really doesn't matter at the end of the day. It's always the right time to invest. It's always the right time to purchase real estate. Now, I know I'm saying opposite things, but it depends on situationally what you're doing, which is why I think having a good advisor that you trust, that you talk about your personal situation, your time horizon matters as much as anything.
Jason?
So question, we talk a lot about home sales prices, interest rate, and basically all of that's boiling down to purchasing power. How do those interact to create a purchasing power indexation that you can track over time to say, are you in a strong purchasing power position, and what will those trends be statistically?
I think you should answer that question.
Regionally or like the case show?
Regionally.
Okay. Like, regionally it's tougher to extrapolate unless you're actually pulling those numbers directly. Because most of us rely upon the Case-Shiller housing price index to help you come up with those numbers. You can determine your own buying power relative to the rest of the marketplace. So that's where having a local representative who knows the local market that you are focused on makes a huge difference, because that data is really difficult to pull unless you know where you're quoting. So there's no great index. A lot of my stock trading buddies, right? They'll buy these programs that say, okay, there's X amount of volume, there's X amount of price, there's X amount of down pressure. It's made this crazy trapezoidal, whatever. It's buy. You got a green candle, or whatever they say. Buy the green candles. And so we don't necessarily have that. And it's a little bit more complicated than that too, when you're dealing with all the sub-markets and subsectors of each sub-market. So I wish there was. If that existed, we'd all be filthy rich. and living off of compound interest?
I do think it's a great question. I think it's something that's worth more study if you want to look into it, because I think you're probably onto something there. I don't know the answer to it, but I think there is an answer to it.
It seems to correlate, since I'm a hiring business, it correlates to the availability of workforce in the market as well, which is really interesting. As the purchasing power increases, you have more worker availability for investing and actually redevelopment of business. So it's really interesting to find what that index is as an indicator to predict in the future.
So your local chamber of commerce is going to have a lot of that predictive math available. And they're going to have it from the business perspective, right? Because they're going to be sharing that with potential businesses. And they're going to show the relative purchasing power of those potential employees as a way to show you, hey, this area is affordable. If you want to do your manufacturing business here, and you have 50 employees that make $25 an hour, this is a very affordable place. It's all proprietary. There's not an industry accepted math equation for that. So I'd say start with the Chamber of Commerce and see what they've got.
Thank you.
Jason's new business just started here at Cedar Glade, so he's going to write that index.
Maybe.
Hey, John.
Charles.
Kind of as a question, flipping the script a little bit, because I know all of you guys are from the buying perspective. Flip it around and look at the rental side. So as a entrepreneur who's got a couple of rental properties out there looking, knowing that my population typically is the younger population who has a newer car and probably some of that higher debt that goes with that, which limits their purchasing power. From my outlook, I think that I've got a pretty rosy outlook going in the next 3 to 5 years, just based on Middle Tennessee, everything we've talked about tonight, where it's a good place for industry to come. It's great for those type of people. We have plenty of talent. What does that look like for us from a owner of rental property? Do we think the rates are going to increase and then kind of bump up against what they can purchase based on, there is no, and John, you can kind of help, 250 or below, what's the population in Rutherford County? There's none. So it really starts to go back to my original questions. What is those of us that have kids that are looking to buy a house based on rental, based on longer term, where are they at? What are they looking like?
So, give me a little more detail, make sure I understand the question there. So are you saying, are we talking about housing stock availability? Is that what you're getting at?
Both. I'm thinking, so as a rental owner,
Right.
What should my outlook be based on from y'all's perspective? Y'all see the bigger picture with the purchasing power of everybody in the market. At the same point, I know that from a inventory perspective, it's really low for that entry level. So I'm trying to figure out, can you quantify or qualify that my 3 to 5 day rosy outlook is true? Or should I be thinking about something different as I'm going down the road?
This may not be exactly the answer you're looking for, but you can say you didn't answer my question and I'll try again. But I would say things like Tullahoma, Shelbyville, Manchester, Woodbury, McMinnville, the more rural markets, I think you can get better value for the properties that you purchase there. I think Murfreesboro, specifically Rutherford County, has appreciated pretty quickly the last 2 or 3 years. A lot of the stuff I've financed over the past 2 years has been out of market, because that's where, when you look at the value proposition of return on investment, what's my equity, what am I getting from a return on my equity standpoint, and what's the potential for appreciation. I'm not telling you there's greater chance for appreciation in some of those other markets, but I think what has been obvious is if you weren't already an owner in 2020, 2019, 2021, most people believe today that you may have missed the opportunity to catch that big lift for that 2 or 3 year period. Doesn't mean it's not going to go long term, because I think it will. But if I'm a real estate investor, I think it's really hard to make the math work in Murfreesboro, Tennessee. And so, again, some of those other markets, surrounding markets, I think there's some good value there. I don't have a better answer.
So are you saying that rents, from what you're saying, is that rent costs have not kept up with the appreciation of the cost of the asset?
I think my personal opinion would be if you've got professional property managers that are managing a property and they've got a pool of tenants that are not going to destroy your stuff, right? They're not going to burn it down. They're not going to put 25 holes in it. Or when they leave, it's going to cost you $10,000 to rehab. Yeah, I think the cash flow doesn't work. If you bought that asset in 18, 19, 20, 21, I think it's really hard for it to work. If you bought the asset in 2009, 10, 11, 12, 13, you're smoking because you picked up the lift in rents when you purchased, at a very affordable price. But I think things got really expensive, again, 18, 19, 20, 21, and the rents lagged. I think they have caught up. But my personal opinion on this would be, this goes back to consumer confidence. Turnover, when you look at the math associated with a rental property, you miss 1 month of rent in a 12-month period, your math is just screwed, right? So your return is just messed up. It's not gonna work. You miss one rental payment, it's messed up. So when you start talking about the risk of having that asset out there that's not producing revenue, you might be able to cash flow, but when you're looking at a pure return standpoint, the return is totally messed up. So what people do is they tend to keep rents artificially low so that they don't have those vacancies. And so what they want is they want to keep people in there for a year or 2 or 3 or 4. So I think the rents have lagged. I think people that are better at it than I am know who they can rent to and can generate better returns. But you might be able to do that. If I'm managing a rental property, I'm going to get beat up because I'm scared to death, because I'm going to be like, hey, this is probably a $1,700 month property. You give me $1,250 sold. Just don't leave. Just don't mess up my return where you're not there in December, so I don't get $1,250 because then all the math sucks. Right.
I don't have any data or analysis on what rents are going to do, but I do think you may be onto something with you're going to probably not have any trouble finding renters, because the average home ownership age seems like it's moving up. Couples have to get together to buy a house and combine their incomes. So the average first-time homebuyer's age has risen. I don't have the data to tell exactly what it is, but just common sense and looking at the clients that I work with, it's higher. So they're going to rent for longer, or they're going to live with family longer while they save for their down payment and build their careers to where they know where they want to be to buy their home. So I think this generation that's coming up behind the millennials is a huge generation. So as millennials are entering into this home buying age, and very well, a lot of them are on their second and third homes at this point. There's a generation coming behind them that's going to rent. Yeah, they're going to rent for a while. So I think you've got a stability of renters, but with that many renters out there, how much can you raise rental rates? So you may, I think you'll have no trouble getting it rented out, but I don't know what your prospects are for the rent roll. Maybe Grant can give more insight on that.
So I own 10 long-term rentals, 10 short-term rentals. Used to own a lot more long-term rentals. But started trading for short-term rentals in the Nashville marketplace. I also used to own a property management company called Summit Property Management that had 672 properties under management under long-term rental. That was
You should have just told us to stop talking.
But
Please do that next time.
we sold that company to Qualia a couple of years ago, which is a huge national, juggernaut, and happen to have a board seat with them now, and they are suggesting in the Nashville MSA an easing of rental rates for the next 6 to 9 months, just based on thought, fear, uncertainty, doubt. That there are homeowners that will say, you know what, it's $1,700, but if you're gonna stay for 5 years, I'll take $1,250. That's the fear, uncertainty, doubt that they think is gonna creep in the marketplace over the next 6 to 9 months. So if you're not renewing or signing up new tenants during that point in time, hopefully you won't fall susceptible to that. But long-term, over the next 5 years, they see around a 14% growth in rental rates. So I think you're dead on that a lot of that's supply driven, right? We're not building enough houses. Historically, we've not been building enough houses in this country since the Great Recession, right? Because so many builders got crushed. And municipalities are making it more difficult to build houses. City councils are a lot less likely to zone for higher density. And so we're not building enough housing, and it's going to get worse under this short-term crunch that we're under with the Fed funds rate that, will probably peak over 5% this year. And so we're not going to be building a lot more houses. So a little short-term dip, right? Just like on home prices, like you get these little roller coaster dips on the way up to the top. That's what's going to happen with rental rates in the natural MSA during the next 5 years. Thank you all. Bye.
Can I follow up on that with a question? Why are municipalities so adverse to zoning for high density? What's the?
We should ask.
I was gonna say, Ronnie Martin, you're very well qualified for this one.
I should have probably not talked about half the time and just answered this question. But the short answer is there is pressure, right, on affordable housing. And so we've talked about that some, that we want more housing stock at a more affordable price. Cost of construction is higher. We've talked about that some. The only way to fix that model is to increase density. And so as builders and developers can build, if you've got a 1 acre lot and the zoning allows one property, you only have an opportunity to build one home. If you can build 2, the math gets better. If you can build 4, the math gets better. If you can build 32, the math gets amazing, right? And so as an investor, as a developer, you're thinking, why wouldn't we do that? Well, then the issue becomes the burden of services for the municipality. And there are other burdens that come with it, but how do we make sure that there is a safe environment for the residents of that development? How do we make sure there's adequate policing? So we go through this process where we go through a planning and zoning where we say, can we provide services to this? And, if it was designed to be a 1-bedroom house and there are 32 families that are going to reside there, what impact does that have on the community? How does it diminish the community? And what you have to realize is we have lots of conversations about the cost of those things. So if you live in a neighborhood, this is the way this stuff works. You're like, hey, I think we need affordable housing. I think we need more housing stock. Awesome. Until that lot beside you becomes available and we want to put 32 houses on it, and everybody freaks out, right? That's just what everybody does. And so what happens is on every piece of property in the city, everywhere, somebody's freaking out because that's getting ready to happen. And so what happens is your local elected officials, they feel pressure to feel, by the way, I was elected once and I didn't run again, just so everybody knows. But, your local elected officials feel pressure because they say, hey, I like this job. I like it. It makes me feel special when I'm up here at the city council. And I'd like to do it again. And if I make people mad, guess how hard it is to do that again? It's really hard to do. I was like, this job sucks. I don't want to do this again. So I'm not doing this again. It doesn't really suck, right? It's just hard.
Yeah.
And it can suck sometimes. But, all the things that people talk about from a community service standpoint, all those things are true. You do get to make an amazing difference in your community. You absolutely do. But it is extremely difficult. It is extremely time consuming. And you hear people talk about you're never going to make everybody happy. That is the truth, brothers and sisters. It is absolutely the truth. So it goes back to the quality of what you want the community to look like. There are some people in the community. I would be one. I live downtown in Murfreesboro. If I could tear my house down and build 2 or 3 or 4 there, I would. And people would be really mad at me for it if I did. There are other people in the community that think that you should build 75 units there and go up and build a condo. I'd be that guy. I'd do that to your downtown Murfreesboro, which is another reason I didn't run for city council. To be honest. You don't want to campaign on that sort of thing. So I think the answer is, density is the way you make it work, is the way the math works. But it is a very unpopular thing in smaller, more rural cities like ours. Nashville, they wouldn't even blink at it. They'd say, give it to us, we'll stack it up, we need the units. But in our community, it's tougher to do.
Yeah, I'd say part of that also is that the built environment is already right-sized to the zone. And so your road widths are already zoned to handle the traffic that the property in the surrounding area is zoned for. So unless you have public transit of some kind, and that's extraordinarily expensive. I don't know if you guys remember, but when Megan Barry was mayor of Nashville, she tried to pass a $5 trillion transit bill, trillion with a T, transit bill. And that's what it costs to build the rail, the subway, the bus to handle that real density. So in the suburban areas that are already built, that have the road capacity, you've already got the restaurants pulled up to the streets, and there's no way to really expand the roads. You're not really going to be able to handle more density. And as Jonathan told me earlier today, like Murfreesboro is 45 minutes from Murfreesboro now. Like, that's exactly why you're not going to get the density, which is why you're not going to get the affordability, which is why your property is probably going to go up in value.
Yeah. Well, we're about to wrap it up. Any other questions?
I'll ask one more. I'm sorry, but it's one that you said a bunch of times. If you locked in your rate in 2020, you won, basically. So how do you take that, especially if you're a seller, and use that? Can I have someone purchase my note so that I can get a higher selling price because they can get my now sub-3 rate? How do I market that to be more effective?
Well, chances are you probably have a conventional mortgage and it's not as simple. If you have an FHA, VA, rural development loan, then that can be used to market your residency. You have a mortgage that somebody can assume. You're going to have to find a buyer who can cover the gap between your sales price and your mortgage balance. So you're going to need somebody with you're going to need somebody with a lot of cash to be able to make a significant down payment. If you do have an FHA loan, most likely that's probably what you've got. If you have a loan that's assumable, it's probably FHA. But most likely, if you refinanced or you bought and were able to go under contract in 2020, you didn't do it with an FHA loan. You probably replaced it with a conventional. So, unfortunately, you have a 2% rate for as long as you want to keep that mortgage. Not a bad problem to have.
Yeah, you got a great rental.
Yeah, and that's a great point. A lot of people will probably leverage that by saying, "Hey, this is my primary residence. I'm going to tap into the equity through a home equity line of credit. Rates are going to be susceptible, so you're going to have some fluctuation with that, but you can leverage the equity that you have in there to go buy another home, and then now you've got a investment property with the primary fixed rate mortgage. It's very attractive, but you won't be able to replicate.
That's an important point, right? So the easiest way to build a rental portfolio is not by buying rental properties, it's by buying more primary residences. Every 2 years, you can buy a primary residence, and your old primary residence becomes a rental property. That's how I started my entire career 23 years ago now, was I bought a primary residence in a place where I knew it would have good rental potential. And then the second primary residence I bought 2.5 years later was 5 doors down. And then the third primary residence I bought 2.5 years after that was 3 blocks away. That is the easiest, cheapest way to build your portfolio. Now, should you report to your mortgage lender that it's your old primary is now a rental property? No, they've sold that loan at least 3 times. They don't care. They really don't. They may audit your file.
They do if you're THDA.
Well, okay, we're not all conventional.
Yes.
Yeah.
Please stick
THDA,
to
notwithstanding.
caveat,
With Fannie,
conventional.
with Fannie and Freddie both, we can use the income on your party residence. Fannie makes it very easy. Freddie's a little harder, but with Fannie, it's very, very easy to even use the rental income from the house you're leaving behind to help qualify for your next mortgage. So no, we
That's
really
the
don't
game.
care.
That's the game right there. I just decoded it. Move every 2.5, 3 years. And don't live in the mega mansion that you always dreamed of. Live in a house that, that's fairly modest for 2.5, 3 years, and then you go do it again.
But rentable, modest and rentable.
And rental.
Your banker appreciates all these comments. These are very wise comments.
Ronnie is going to be auditing everybody that's standing up here on this carpet. But, all right, one last thing. If you guys have just a departing word, if you want to share a product at your particular institution, if you want to pimp a property that you have for sale, whatever you want. Whatever you want to say to this room full of people, you got about a minute each.
Okay, I'll go first. We have said multiple times tonight that who you choose to do business with is extremely important, and I'm going to emphasize that, whether it be your attorney, insurance provider, real estate broker, agent, mortgage lender, banker. I would encourage you to find people that you trust and that you know, and ask them lots of questions. Challenge them on those things. Make sure they understand what you're trying to accomplish, what your personal goals are. Because I think that it's always a good time to buy real estate. It's always a good time to invest, as long as everyone is on the same page of what everyone's trying to accomplish. So,
Jonathan, thanks for putting this together and having this out. And thank you all for coming. I'd be remiss if I didn't say thank you for that, because we do appreciate having some people to talk to tonight. I'd say if there's just to boil it down to one thing besides who you know, like, and trust, it's to ask who you're working with about programs. If I buy now and rates go down in 5 months, what's that mean to me? So we've got the premise bounce back program. So it's a program. I mentioned it earlier. We're not the only ones that do this, but it's something that we brought to market here recently, where if you buy a house and you make the 6th payment and rates are better, we'll refinance it for you with no lender fees and an appraisal voucher. If you even need an appraisal, most likely you'd end up with an appraisal waiver. But if you do need an appraisal, we'll take care of that as well. So I just do think that this is a great time to buy a primary residence, and if that's something that you plan on doing this year, I'd love to sit down with you and discuss your situation.
Yeah, for me, I'm thankful to live in Tennessee and Middle Tennessee at that, right? I'm in a community of people who aren't super susceptible to fear, uncertainty, and the doubt, and the headlines that you get from media, skies falling, bubbles popping, markets cratering, all that kind of good stuff. And fundamentals here are the fundamentals that you write about in textbooks, right? So the fear and the uncertainty and the doubt that is sort of permeating throughout the country is really coming from areas where the fundamentals aren't in place. That's really economic fundamentals more than anything else. We live in a society here where we're a little more conservative when it comes to buying houses and buying cars and buying boats. We're not all living in $3 million houses with our $280,000 weight boats, with our Ford F-350s jacked up that cost us $160,000. But we could afford that stuff. But we make smart decisions, right? And so fundamentally speaking, I would say just for the next 6 months, you're going to see some really negative news that's going, and negative news sells. We all know that. So you're going to see some really bad headlines that seem really bad, but read the article and look at it through the lens of living here in Middle Tennessee and the things that we've all talked about here today. The headline is going to try to grab you. Recession is going to be in giant black type. It's going to be the whole first quarter of the newspaper, if you still get a newspaper. There's going to be the paper boy in the corner. Yeah, it's going to recession. Everyone's going to hell. It's going to hell. It's going to be it's going to feel like that. So just, look through that stuff, read the article, talk to your financial planner, to your mortgage broker, that kind of stuff. The last thing I say is, if you're going to sell a house in Rutherford County, you should call and talk to them.
Thanks, Grant. Hey, I'll bounce that back at him. If you are interested in short-term rental investing in Davidson County only, not in Rutherford County, but in Davidson County, Grant has learned and stays up to date with all of the craziness that Davidson likes to put on those short-term rentals. I actually had a client that I was going to try to help, and then I started looking into all of that, and I was like, yeah, this sucks. So I called Grant, and Grant helped him, took care of it, and he's super happy with what he's got. So he's the best in the business at that. That's all we got up here. Thank you guys for coming. Thank you for showing up, for asking questions. Jason, thank you for asking lots of questions. And it's good. And Charles too. And if you guys do have any mortgage needs, call my friend Brian. If you have any commercial stuff going on or just want to bounce some stuff off of Ronnie, that's cool too. And of course, if you have any real estate needs or your friends do, give us a shout. And thank you, Trent, Spread the Positive, for making this go live. Thank you very much. And that's it.